Welcome to the deep dive. We're grabbing our gear and plunging into a topic that seems like it should be simple, but, well, it has layers, doesn't it? Your credit score.
It really does. It touches so many parts of our financial lives.
Exactly. So we've gathered a whole stack of sources, articles, notes, research, really trying to cut through all the noise and get to the core of, what this number is, why it has so much influence, what actually builds it, and maybe most importantly, how you can actually take charge and make it work for you.
It's such a cornerstone of personal finance, and yet, yeah, for a lot of people, it feels like this black box, maybe something they can't really control. Understanding it is definitely the first step.
That's our mission for this deep dive. Pull out the absolute must-know pieces from these sources, give you that kind of shortcut to being properly informed. We want to help you understand this number, demystify its power, and really show why getting a handle on it matters directly to your financial picture.
Sounds good. Where should we start?
Okay, so let's just jump right in. This number, everyone talks about the credit score. Based on what we've read, how should we actually define it? What is this three-digit number?
Well, think of it like a grade, basically.
Mm.
A numerical grade reflecting how reliably you've handled credit in the past. It's typically a three-digit number, usually running somewhere between 300 and 850.
Okay, 300 to 850.
Right. And lenders use it as a primary tool to quickly gauge your creditworthiness.
Yeah.
It's their snapshot prediction based on your history of how likely you are to pay back money they might lend you.
A prediction based on past behavior. Makes sense. And the sources are clear. It's not just one single formula everyone uses, is it? There are different models.
That's a really important point. Yeah. The most well-known are probably FICO and VantageScore. They both draw from the same pool of information, which is your credit report, that detailed history of your borrowing and payments, but they might weigh certain things a little differently.
Like what sort of things?
Maybe how they treat medical debt, or perhaps how they view multiple loan applications clustered together.
Yeah.
But the fundamental idea is the same. They're analyzing the data in your credit report to generate that score.
Got it. So, different recipes, same basic ingredients from your report. And those ingredients, the sources lay out 5 main ones, right? And even give a sense of their weight, how important they are.
Exactly. The biggest chunk, like 35% of the score, comes down to your payment history. Simple question. Did you pay past credit accounts on time? That's huge.
35%. Okay.
Then the next largest, at about 30%, is credit utilization. This is about how much of your available credit you're actually using at any given time.
Right, the balances versus the limits.
Precisely. After that, length of credit history accounts for roughly 15%, basically how long you've been managing credit.
Longer is generally better, I assume?
Generally, yes. Then you have the types of credit you use, that's about 10%. Having a mix can be beneficial. And finally, new credit, which reflects recent credit applications, also makes up about 10%.
Wow. Okay. So payment history and how much credit you're using, that's 65% right there. Those two are really the heavy hitters.
They absolutely dominate the calculation.
Understanding that breakdown, that it's not just some random number, but built from these specific parts, that feels like the essential first step. That's the foundation for taking control, isn't it?
It really is. Knowing the what lets you figure out the how.
Which leads us right into the next big question. Why should you care? Why does this number actually matter so much? What are the real-world benefits of having a good score? What does this mean for you listening?
This is where it gets very tangible. The sources consistently show that a good score isn't just about bragging rights. It directly impacts your wallet and your opportunities. Probably the single biggest advantage they talk about is getting lower interest rates.
And that example they used with Jane and Mike buying homes, that really illustrated it.
Oh, powerfully, yeah. So take Jane. She's got a strong score, maybe 780. She might qualify for a mortgage at, let's say, 3.5%. Now, Mike, his score is lower, maybe 620. He might only get approved at 5%. Now, that 1.5% difference, it sounds small, maybe.
Yeah, it doesn't sound huge initially.
But over 30 years on a mortgage, the sources show the difference could literally mean tens of thousands of dollars more in interest payments for Mike compared to Jane.
Tens of thousands. Okay, that's definitely not small. That's serious money.
It's a very stark illustration of the cost.
What other advantages do the sources point to?
Well, beyond just saving money, a good score significantly boosts your chances of getting approved for loans and credit cards in the first place. That's crucial for big steps like buying a car or, obviously, a home.
Makes sense.
You're also more likely to be offered higher credit limits, which gives you more financial flexibility, more breathing room.
Okay.
And it goes beyond just borrowing money. Many landlords check credit scores when you apply to rent.
Right, I've heard that.
And even some insurance companies might use credit-based insurance scores to help set your premiums for things like car or home insurance.
Huh. So it really touches a lot of areas, loans, renting, maybe even insurance costs. The sources also mentioned kind of the bigger picture, the broader implications.
Yes, definitely. It boils down to your ability to plan for the future more effectively, whether that's buying that house, getting a car for a new job, maybe even securing a small business loan. A good score just makes the path smoother.
It's about empowerment, really.
It is financial empowerment, feeling less constrained by high costs or just flat-out rejections. And honestly, it contributes to peace of mind, just knowing you have that solid financial footing.
And that footing isn't set in stone. It changes over time. The sources talk about it being a journey.
Exactly. Your score reflects your ongoing financial habits and decisions.
Hmm.
It evolves.
Okay, so let's really dig into how it's calculated. Let's unpack those 5 factors we listed earlier. The sources give us the details, the sort of recipe card for your score.
Right. Let's start with the big one, that 35% chunk.
Yeah.
Payment history. This is pretty straightforward. It's a record of whether you've paid your past credit accounts on time. Timeliness is just critical here.
And what about missed payments? How bad is the damage?
It's significant, and it gets worse the longer a payment is overdue. A 30-day late payment hurts, 60 days hurts more, 90 days or more can do real damage to your score. And things like bankruptcies or accounts going to collections are obviously the most severe negative marks.
They use Sarah's example, right? Missing a utility bill.
Yeah, that was a good illustration. Maybe she missed a utility payment because of a move or a mix-up. Even if it wasn't a credit card, if that unpaid bill eventually got sent to a collection agency and reported to the bureaus, it could definitely drag her score down. That's why setting up reminders or auto payments is such a common recommendation.
Good point. Okay, factor number 2, the second biggest. Credit utilization at 30%. This one's about how much you owe versus how much credit you have access to.
Exactly right. It's that ratio. Your current balances on your credit cards compared to the total credit limits on those cards. The key takeaway from all the sources is keep this ratio low.
How low are we talking?
The general benchmark mentioned is below 30% utilization. But honestly, for the best scores, the sources suggest aiming even lower, maybe 10% or less if you can manage it.
And carrying high balances hurts even if you make the minimum payments on time.
Yes, because it keeps that utilization ratio high, which signals risk to lenders. Maxed out cards are a definite red flag in scoring models.
And they had that comparison, Michael and Tina.
Right. Michael makes it a habit to pay down his balances, keeping his utilization maybe around 15%. Tina, she often carries balances closer to her limits. Even if she pays on time every month, her high utilization ratio will likely result in a lower score compared to Michael's.
Okay, makes sense. Next up, length of credit history, weighing in at 15%. This feels simpler. The longer you've had credit, the better.
Generally, yes. The models look at things like the age of your oldest credit account and the average age of all your accounts combined. A longer track record gives lenders more data to see your consistency.
But there's a catch, right, about opening new accounts.
There is. The sources point out that opening several new accounts relatively close together can actually lower the average age of your accounts. So while you're building history, that initial flurry of new accounts can cause a temporary dip in this part of the score.
Like the Joe and Lisa comparison.
Exactly. Joe's had the same main credit card for, say, over 10 years. That gives him a nice long history. His younger cousin Lisa, maybe she just got a few student cards and store cards in the last year or two. She's starting out, but her average account age is much shorter than Joe's, and the models notice that.
Got it. Then we have types of credit in use, or credit mix, at 10%. This is about variety.
Yeah, basically. Lenders generally like to see that you can manage different kinds of debt responsibly. That usually means having a mix of installment loans.
Like mortgages, car loans.
Right, student loans too, where you borrow a set amount and pay it back in fixed installments over time, and also revolving credit.
Credit cards.
Credit cards, exactly, where the balance can fluctuate and you have a line of credit you can draw on and pay back. Having experience with both types is seen positively.
So if someone only has credit cards, the sources suggest maybe adding an installment loan could help. Strategically, of course.
Potentially, yes.
Yeah.
They used Emma as an example. Maybe she only had credit cards but then took out a small personal loan, perhaps to consolidate some of that card debt. By managing payments on both the installment loan and her revolving cards responsibly, she demonstrated she could handle different credit types, diversifying her mix.
Okay. And the final 10% is new credit. This relates to applying for new accounts, right?
That's it. When you formally apply for new credit card, a loan, The lender typically does what's called a hard inquiry or hard pull on your credit report.
And that lowers your score?
A single hard inquiry usually only has a small, temporary negative effect.
Hmm.
But, and this is the key, applying for multiple new lines of credit in a short span of time can signal increased risk to lenders, and that collection of inquiries can lead to a more noticeable drop in your score.
But didn't the sources mention something important about shopping around for loans? Like for a mortgage?
Absolutely crucial point, yes.
Yeah.
The scoring models are designed to understand that people shop around for the best rate on major loans like mortgages or car loans. So if you have multiple inquiries for the same type of loan, say several mortgage inquiries, all within a fairly short period, the sources mention typically 14 to 45 days depending on the specific scoring model.
Better grip them together.
They often treat them as just a single inquiry for scoring purposes. So Tom, who applied for 3 different credit cards in a month, probably saw his score dip from those separate inquiries. But Sarah, who applied with 3 different mortgage lenders within 2 weeks, likely saw much less impact because the model recognized she was rate shopping for one loan.
Ah, that's a really important distinction for people to know. Okay, so understanding these 5 pieces, their weights, what goes into them, that really gives you the map for intentionally managing your score.
It demystifies it, definitely. Gives you a clear roadmap.
So now that we've got the recipe, let's talk about the proven strategies our sources highlight for actually improving your score. How do we put this knowledge into action? Where's the best place to start?
Well, logically, you start with the biggest piece of the pie. Strategy 1, pay bills on time. It sounds basic, but given payment history is 35% of the score, this is absolutely fundamental. Late payments are the fastest way to hurt your score.
And the sources had simple tips for making sure that happens.
Yeah, very practical stuff. Setting up automatic minimum payment so you never miss a due date, even if you plan to pay more later. Using calendar reminders, maybe scheduling payments around your payday. They mentioned Marie's story.
Right, her score jump.
Yeah, she apparently struggled with remembering due dates. Her score was maybe around 670. She started using auto pay and reminders consistently, and just by establishing that solid on-time payment record over about 6 months, her score reportedly climbed to 720.
Wow, a 50-point jump just from being consistently on time. That's powerful. Okay, strategy number 2 connects to the next biggest factor. Reduce credit card balances.
Exactly. Since utilization is 30%, actively paying down what you owe on credit cards directly improves this factor. The target, again, is getting that overall utilization ratio below 30%, and ideally even lower.
And the advice there is?
Pay more than the minimum whenever possible. Some sources suggest focusing extra payments on the card with the highest interest rate versus the avalanche method, or maybe the one with the smallest balance for a quick win, the snowball method. The goal is reducing those balances relative to the limits.
Like John, who had high utilization.
Right. He was apparently running near 60% utilization. He got serious, cut back on spending, focused on paying down the balances. As that ratio dropped significantly, down below 30%, maybe to 25%, his score saw a really positive improvement.
Okay. Strategy 3, increase credit limits.
This also ties into utilization, but kind of from the other side.
Correct. If you can get your credit limit increased on a card, but you don't increase your spending or your balance on that card, your utilization ratio automatically goes down because the denominator, your total available credit, just got bigger. But the key is not spending more just because the limit went up.
Absolutely critical. You have to maintain the same spending habits. The goal is improving the ratio, not creating an excuse to spend more. The sources suggest you can sometimes request a limit increase from your card issuer, especially if you have a good payment history with them.
And Emily's example showed this working.
Yeah, Emily had been responsible with her card, requested an increase, and got it. Her balance stayed the same, so her utilization dropped, and reportedly her score jumped about 30 points, which helped her qualify for a better car loan rate.
Nice. Okay, strategy 4, diversify your credit mix. We talked about this being a 10% factor.
Right, and it can be a strategy too, but it's one to approach thoughtfully. If your credit history consists only of credit cards, for example, strategically adding an installment loan might help, but only if it makes sense for your financial situation anyway.
So don't just take out a loan for the sake of mixing credit types.
Definitely not. But if you were already planning to finance a car, or if consolidating some high-interest card debt with a personal loan makes financial sense, then that action also serves to diversify your credit mix. It needs to align with a real financial goal.
Like Jake, who used a small personal loan.
Yes, the example was he needed to borrow anyway, chose a personal loan, managed it well alongside his existing cards, and that demonstrated he could handle both revolving cards and installment loan credit, broadening his profile.
Got it. And the fifth proven strategy from the sources: monitor your credit report regularly. This sounds a bit like admin, but they stressed its importance.
It's incredibly important because errors on credit reports are surprisingly common. Some statistics cited suggest maybe 1 in 5 consumers might have an error on at least one of their reports.
1 in 5. Wow.
Yeah, and those errors can definitely drag down your score unfairly. You're entitled to get a free copy of your report from each of the main bureaus, Experian, TransUnion, Equifax, once a year through annualcreditreport.com.
And you need to actually read them.
You do. Look for accounts you don't recognize, payments marked late that you know were on time, incorrect balances, stuff like that. If you find an error, you need to dispute it with the credit bureau.
Like Lisa did with that old paid bill.
Exactly. She found an old collections account listed that she knew she'd paid off years ago. She gathered her proof, filed a dispute, the bureau investigated and removed the error, and her score went up reportedly by 25 points. So finding and fixing errors is a very direct way to boost your score.
These 5 strategies seem really concrete. Pay on time, lower balances, manage limits, consider the mix carefully, and check your reports. It takes effort, but it's clearly doable.
It really puts the control back in your hands. It's about being proactive.
Now, our sources also had a few extra tips, sort of supporting actors to these main strategies, rounding out the whole picture of good credit health. What else should people keep in mind?
Okay, one that often catches people by surprise is avoid closing old accounts, especially credit cards you've had for a long time, even if you don't use them much anymore.
That does seem counterintuitive. Why keep an unused account open?
It affects 2 key scoring factors we talked about. First, closing an account reduces your total available credit. If you still have balances on other cards, closing one reduces the denominator in your utilization calculation, which can actually increase your overall utilization ratio.
Ah, right. Less available credit makes existing balances look bigger percentage-wise.
Exactly. And second, closing an old account removes its history from the calculation of your average age of accounts. If it was one of your older accounts, closing it can shorten your average credit history length, which isn't ideal.
Like Lisa's other example, where closing an old store card caused a dip.
Right. Separate from the error she fixed, she closed an old, unused card, and her score apparently dipped slightly because it reduced her overall credit limit and shortened her average account age a bit. So unless there's a compelling reason, like a high annual fee on an unused card, keeping old accounts open is generally better for your score.
Good to know. And correcting errors, we covered it as a strategy, but the sources really hammered this home again as a general tip.
Yes, it bears repeating because it's so common and can have such a direct impact. Regularly reviewing those free annual reports is key. And if you find something wrong, like John finding a loan on his report he never applied for, you have to dispute it. Provide documentation if you can. Getting those inaccuracies removed, like John saw happen with his score bouncing back, is just crucial hygiene.
Okay. Another tip was about limiting credit inquiries again.
Yeah, just reinforcing that new credit factor. Be mindful about applying for credit too frequently. Plan ahead if you know you'll need a loan. And remember that rate shopping nuance, cluster your applications for a specific loan type, mortgage, auto, within a short time frame.
And maybe look for pre-qualification options.
Good point. Yes, many lenders offer pre-qualification tools that use a soft inquiry, which doesn't impact your score, to give you an idea of whether you'd likely be approved and at what rates before you formally apply and trigger that hard inquiry.
Smart. And the final tip, which feels like it underlies everything: use credit wisely.
It really is the foundation. It's about sound financial habits overall. The sources emphasize things like having a budget, not spending more than you can comfortably repay, and ideally, using credit cards as a convenience tool rather than a way to finance things you can't afford.
Like paying the balance in full each month.
That's the gold standard mentioned.
Right.
Like Mark's example, using his card for planned, budgeted expenses, then paying the statement balance in full every single month. He avoids interest charges, keeps his utilization extremely low, and builds a flawless payment history. That's a recipe for a steadily climbing score.
These extra tips really reinforce that managing your credit score isn't just this isolated task, it's woven into your everyday financial habits.
It's all interconnected, absolutely.
So as we kind of wrap up this deep dive, the big message coming through from all these sources seems really clear. Your credit score is, well, it is a powerful number, and understanding how it works truly gives you the ability to shape it.
It really does. And shaping it positively opens doors, better loan terms, saving real money, accessing opportunities, and just providing a greater sense of financial stability and, frankly, peace of mind.
Mhm.
Like Maria, who worked on her score and was able to secure that great mortgage for her dream home, it enables things.
Yeah. And I found it interesting. The sources sometimes didn't just call it a number. They used phrases like seeing it as an ongoing project or even a symbiotic part of your financial health.
That's a really insightful way to put it. It
Yeah.
suggests it's not something you just fix once and forget about, right?
Hmm.
It requires ongoing attention, and it reflects and influences your overall financial well-being. Symbiotic is a great word for it.
It is, isn't it? So just a final thought for you listening. If your credit score really is this ongoing project, this symbiotic part of your financial life, what does that framing mean for how you approach managing your own finances day to day? And knowing everything we've unpacked today, what kind of control does that knowledge actually give you over your own financial journey?
Probably more control than you might have thought.
Definitely something to reflect on. Thank you so much for walking us through all of that today. That was incredibly helpful.
My pleasure. Glad to dive into it.
And thank you for joining us for this deep dive. We hope you feel more informed and ready to make your credit score work for you. We'll catch you next time.